Hello everyone, Edward here. In this video today I'll be going over 5 high growth stocks that you should be buying this December. These companies have a really great future ahead and I believe they should double in the next 5 years. So please stick to the end of the video to see if any of these stocks are worth purchasing. In today's agenda, in no particular order, I'll be going over the 5 stocks and I'll let you guys know the reasoning on why you guys should be buying it this month. Before we dive right in, I ask you to please smash that like button down below for the YouTube algorithm. Thank you. So the first stock on my list is Advanced Micro Devices, also known as AMD. For those that don't know, AMD focuses on semiconductors, especially in the GPU and CPU space. They just released their new GPU and CPU lineups and the numbers are crazy. AMD's new top-of-the-line graphics card can actually compete with Nvidia's top-of-the-line graphics card. And if you look at the numbers, they are pretty much neck to neck. What's awesome about this is that AMD's GPU only costs $999 compared to Nvidia's, which is about $1,500. That is a $500 difference. What's funny was that when I was watching the live stream, the chat was just saying rip Nvidia, rip Nvidia, rip Nvidia. If we look at their other competitor, which is Intel, they are super behind because their 7nm processor won't be coming until 2022. For those that don't know, this is actually a big deal because all the chip makers are currently at 5 to 7 nanometers, and the smaller it is, the better the performance. Further on, I have to say that Lisa Su is probably the best CEO that ever ran AMD. The company was at the verge of bankruptcy, and when she came in, everything changed. This is probably, in my opinion, the best comeback story since Steve Jobs went back to Apple. The stock was literally $2 back in 2015, and whoever bought it at that time, I just want to say congratulations because you did your homework. If we look at their financials, they have a great cash position of $1.7 billion and a long-term debt of $578 million. They have a current asset of $5.5 billion and current liabilities of $2.4 billion, which is amazing. So if we do the math, we can see that the current ratio is 2.28. They have a top line of $2.8 billion and a bottom line of $390 million. Lastly, they have an operating cash flow of $950 million and a free cash flow of $697 million. So the company actually hits my checklist, so they have more cash than debt. They have a current ratio of more than 1. Their revenue are growing year over year, they're profitable, and they have a free cash flow. Now we'll get into the second stock, which is Lemonade, and the ticker symbol is LMND. This company has been on my watch list for a while and I want to share with you all today. Please keep this in mind because this is a spec stock. They focus on the insurance business with their app called Lemonade. Everything about this company is online, so there isn't a physical place to go to. At the moment, they only focus on homeowners, renters, and pet insurance. What's neat about this company is that they only take 20% off your premium and the 80% actually goes to you. At the end of the year, if there's anything remaining, you can actually donate that to any charity of your choice. When someone files a claim, the AI system will read it and check if it is legitimate. If it is, a payout will be paid out in less than 5 seconds. With machine learning and instant gratification, it is perfect for their target audience, which is the millennials. The reason why this company even formed is because that the CEO figured that the insurance business was unloved. Because let's be honest here, who really likes their insurance companies? Generally, people think of insurance companies as old sneaky businessmen that steals your money. Other insurance companies take their whole entire premium and puts that as their revenue. Sometimes when customers submit a claim, they don't even get the full amount for the damages, but they've been paying insurance for 10 years. Isn't that kind of sketchy? One aspect that I look for in a company is if the customers really love the product, and I must say Lemonade does a great job at it. This is actually the secret recipe to businesses such as Amazon, Tesla, and Airbnb. Now if we go into their financials, we can see that they have a cash position of $575 million, no debt whatsoever, which is fantastic. They have a revenue of $17 million, which was down from last quarter, and they have a net loss of $121 million. They have a negative operating cash flow of $88 million and a negative free cash flow of $92 million. So in terms of their income statement and their cash flow, they aren't really doing too well, which is why I said this is a spec stock. But keep this in mind, growth companies usually burn cash in order to grow. Now we'll get into the third stock, which is Airbnb, and the ticker symbol is ABNB. I made a video about this saying that I will be creating a huge position on this company because I believe it is undervalued. This company focuses on their online vacation rental business, and their mission is to actually make you feel like home anywhere in the world. But the double meaning underneath is to actually solve the issue of trust between regular people and strangers. For those that don't know, usually when you book an Airbnb, you could be living with strangers. But this is where friendships and connections from all around the world can be unlocked. If you haven't heard the story of how Airbnb started, I highly recommend you to go search it up on YouTube. Brian Chesky is a CEO that I'm willing to bet on. His thought process and critical decision making are very strategic, and if it wasn't for him, Airbnb would not be a thing today. I'll quickly go through the valuation because that's the reason why I'm buying. The company is actually planning to go public at about $30 billion. Last year, Airbnb was valued at $100 billion in the private sector. If this is the case, I believe that once everything goes back to normal, then I believe that the travel industry will spike back up because everyone is itching to travel. Even I am itching to travel. I need to go to Japan. That was my plan this year. I did not get to go. Now we'll get into the fourth stock on the list, and that is Tesla, which is the ticker symbol TSLA. Long term, I already told you guys that I believe that this will at least hit a $2 trillion market cap by 2030. However, this is only possible if Elon Musk is able to execute on his roadmap, but based on his track record, I do not want to bet against that. So I believe that you can still 4x your money if you were to buy your stock today and hold it until 2030. Some even say that Tesla might even reach a $4 trillion market cap or a $10 trillion market cap, which is mind-blowing. That blows my estimates out of the water. If you have a strong conviction for Tesla, then I believe you should just buy it and hold it for the next decade. Tesla still has their Q4 delivery numbers to be announced, and if they do hit the estimates, I'm not gonna be surprised if the price goes up. However, if they don't beat the estimates, then that is a great buying opportunity. I personally had 3 entry points into Tesla. The first one was back in March, the second one was before their stock split, and the third one was just recently before they got added into the S&P 500. All in all, I think the next news that will spike up Tesla stock would be the Q4 delivery numbers, so watch out for that. This company is trying to transition our world to sustainable energy, and I believe that solar roofs and their self-driving vehicles are such a great combination to that. I wouldn't be surprised if further down the road Tesla just thinks of another crazy product that will help our world. The last stock on my list is actually an ETF called ARKG, and the ticker symbol is ARKG. I recently bought some shares of this into my account because I do believe that this sector will cure cancer and all the other genetic diseases around the world. For those that don't know, there's actually a technology out there called CRISPR-Cas9, and what it can do, it can edit your genome. So this means that if a part of our genetics is mutated, then this technology can come in and edit it and replace it with a healthier gene. This industry is still in its early stages, so there's plenty of room to grow. I just want to say that I'm not a doctor and I did not pursue science as a career, which is why I did buy this ETF. I believe in Kathy Wood and her brilliant team with their research, so I will be holding this ETF for the next 20 years. Now we'll get into the bonus clip, which is tip of the day. And the tip of the day is dividends are a good thing, but also a bad thing. Let me explain. And I personally learned this from Chamath Palihapitiya, which is a venture capitalist that I really look up to. Sometimes you may see a company that gives out a dividend for every share you own, which is great for investors, no doubt about it. Some people actually live off the dividends. However, whenever I see a dividend, I think of the CEO saying this: "Hi, I don't know what to do with my money, but here you go." If you're a CEO of a company, you should be a great allocator of capital. When you invest those back into the business, usually your stock price will go higher. All that capital being given out could have been used for R&D, acquisitions, hiring more employees, raise wages, etc. I understand that some people live off dividends, but when I see this, I think of the CEO not knowing what to do with the money because they're not a good allocator of capital.
Justin, you keep saying propping up zombie companies. Are you arguing to let airlines, for example, fail?
Yes.
Why? I mean, how does that make sense in the broader scheme of the economy?
Because it's not, because when you look at what it means, this is why I'm saying, like, this is a lie that's been purported by Wall Street. When a company fails, it does not fire their employees. It goes through a packaged bankruptcy, right? If anything, what happens is the people who have the pensions inside those companies, the employees of these companies, end up owning more of the company. The people that get wiped out are the speculators that own the unsecured tranches of debt or the folks that own the equity. And by the way, those are the rules of the game. That's right, because these are the people that purport to be the most sophisticated investors in the world. They deserve to get wiped out. But the employees don't get wiped out. The pensions don't typically get wiped out.
Why does anybody, I just don't understand, why
people.
does anybody deserve, using your word, to get wiped out from a crisis created like this? How does anybody deserve to get wiped out?
Well, but just be clear, like, who are we talking about? We're talking about a hedge fund that serves a bunch of billionaire family offices? Who cares? Let them get wiped out. Who cares? They don't get to summer in the Hamptons? Who cares?
That wraps up for this video. I hope you guys learned something new today. Please smash that like and subscribe button down below for the YouTube algorithm. Thank you for watching and have a great one.